Hello, and welcome to another episode of Main Street Money, where Wall Street meets Main Street. I'm Andrew Gay.
I'm Zach Green.
As always, our goal here is simple. We take what's happening in the markets, the economy, and your financial life and try to explain it without all the Wall Street jargon. Now, we're recording this on Thursday afternoon, so a few of the numbers could move around before the end of the week, but assuming things stay about where they are, Wall Street looks like it's wrapping up its first meaningful losing week in quite a while. Now, before anyone gets too concerned, this isn't one of those weeks where the economy suddenly fell apart. In fact, many of the underlying economic fundamentals still look pretty solid. Instead, investors spent the week digesting a combination of corporate earnings, rising oil prices, and renewed geopolitical uncertainty. So today we're going to unpack what actually happened and, more importantly, what it means for long-term investors. Segment 1, Wall Street takes a breather. After spending much of the summer pushing towards record highs, markets finally slowed down this week. If current trends hold, the Dow, S&P 500, and the NASDAQ are all on pace to finish lower for the week. And honestly, that's perfectly normal. Markets don't move straight up forever. Sometimes investors simply pause, lock in a few profits, and wait for the next batch of information.
I think investors sometimes forget that. If the market goes down for 3 or 4 days, suddenly every headline makes it sound like something's broken. When in reality, healthy bull markets almost always have periods where they pause, consolidate, and catch their breath.
Right. One losing week doesn't erase a very strong year. In fact, if you zoom out 6 months instead of just 6 days, the market has still had a fantastic run. Zach, one question we've already heard from clients this week is, should I be worried that the market finally pulled back?
Yeah, and my answer is almost always the same. The first thing I ask is, what has changed about your financial plan? And then if you're still retiring on the same timeline, have your goals changed? Has your risk tolerance changed? And if none of those have changed, then 1 week's market performance probably shouldn't change your investment strategy either. Um, that doesn't mean ignore your investments.
Right.
It's always a good time to review your allocation and make sure your portfolio still matches your objectives, but that's very different from making emotional decisions because markets had one rough week.
That's right. Good investing usually isn't exciting. It's staying disciplined when emotions start getting really loud. Segment 2, earning season finally matters. The biggest story this week was earnings. Two of the biggest companies in the world, Alphabet and Tesla, reported results, and investors didn't love what they heard. Both companies continue to invest aggressively in artificial intelligence, but Wall Street is becoming more focused on when all of that spending will actually translate into stronger profits.
I think that's an important distinction there. Neither company suddenly became a bad business overnight. The question investors are asking right now is, when do these massive AI investments start producing some meaningful returns? And for the last couple of years, investors were willing to give these companies the benefit of the doubt.
They were.
But now expectations are higher.
And markets don't just react to whether a company beats earnings estimates, they react to expectations. Sometimes a company reports a great quarter, but if expectations were a little higher, the stock goes down. That's what makes earnings season so interesting. It's as much about the future as it is the past. Segment 3, oil, geopolitics, and interest rates. The other major story this week came from overseas. Surprise, surprise. Renewed tensions in the Middle East pushed oil prices sharply higher as investors worried about possible supply disruptions. Those higher energy prices also revived concerns that inflation could stay elevated longer than expected.
And that's why treasury yields moved a little higher this week. If investors think higher oil prices could eventually feed into inflation, then naturally they start wondering whether the Fed may need to keep interest rates higher for longer.
That's right. And it's another reminder that markets are constantly trying to price in tomorrow, not yesterday. One geopolitical event, one earnings report, one inflation number. None of those individually tell the whole story, but together they help shape where investors think the economy is headed. Segment 4, our financial planning corner. Diversification isn't exciting until it is. Every week, we like to connect what's happening on Wall Street to something practical and relatable. This week, I think the lesson is diversification, because this week is a perfect example of why we don't build retirement plans around one company or one single theme.
Exactly. Alphabet is still a phenomenal business, and Tesla is still a very innovative company. but even great companies have disappointing quarters. That's why diversification isn't designed to maximize returns every single week. It's designed so one disappointing stock or even one entire sector doesn't derail your long-term financial plan.
That's right. Long term, especially for retirees. If you're relying on your investments to generate retirement income, concentration risk becomes even more important. We love owning great companies. We just don't want one company determining whether someone can retire comfortably.
And that's where working with an advisor can really help. Sometimes it's not about finding the next great investment. Sometimes it's simply about making sure your portfolio isn't taking on more risk than necessary.
Segment 5, the big takeaway. Let's wrap things up. This week reminded us that markets don't move in straight lines. Stocks took a breather. Oil prices moved higher. Big tech earnings disappointed investors. And geopolitical tensions added another layer of uncertainty. That's nothing new, but stepping back, the bigger picture hasn't changed all that much. The economy is still growing. Corporate America is still making money. Consumers are still spending. Markets are simply becoming a little more selective after an incredible run.
I think that's really the message this week.
I agree.
A pullback is not the same thing as a panic. Sometimes it's just the market resetting expectations.
It is. If there's one takeaway this week, it's this. Don't confuse short-term volatility with long-term risk. 1 week doesn't define a year. One earnings report doesn't define a company, and one headline shouldn't define your investment strategy. Stay disciplined, stay diversified, and keep your eyes focused on your long-term financial goals. Zach, thank you as always for joining me.
Always a pleasure.
And thank you all for joining us for another episode of Main Street Money. If you enjoyed today's conversation, be sure to subscribe on YouTube and Spotify, follow us on Facebook and LinkedIn, and visit us anytime at TexasHillCountryAdvisors.com. Have a wonderful weekend, and we'll see you right back here next week.